In the wake of the 2008 financial crisis, one of the most severe economic downturns since the Great Depression, the Federal Reserve embarked on an unprecedented monetary policy experiment known as quantitative easing, or QE. This bold strategy was aimed at stabilizing the US economy and preventing a further financial collapse. In 2008, the collapse of major financial institutions triggered a global financial panic. The stock market plummeted, credit markets froze, and consumer confidence hit rock bottom. Amidst this chaos, the Federal Reserve, under the leadership of Chairman Ben Bernanke, recognized that traditional monetary policy tools were insufficient to tackle the crisis. Quantitative easing is a monetary policy whereby a central bank buys predetermined amounts of government bonds or other financial assets to inject money directly into the economy. The primary goal of QE is to lower interest rates and increase money supply to stimulate economic growth. The Federal Reserve launched its first round of quantitative easing, QE1, in November 2008. Over the next few years, the Fed would introduce QE2 and QE3, expanding its balance sheet to over $4 trillion by purchasing long-term securities. The effects of quantitative easing were profound and multifaceted. By lowering long-term interest rates, QE helped revive the housing market and encouraged business investment. Consumer spending received a boost as financing costs dropped, gradually restoring confidence in the economy. However, QE was not without its critics. Some economists argued that it could lead to hyperinflation, while others worried about bubbles in asset prices due to the influx of cheap money. There were also concerns about the long-term effects of having such an expanded central bank balance sheet. The US wasn't alone in its approach. Central banks around the world, including the European Central Bank and the Bank of Japan, implemented their own versions of QE in response to the global economic slowdown, making it a key tool in the international policy arsenal. Beginning in 2013, the Federal Reserve started to taper its asset purchases as the economy showed signs of recovery. The process of unwinding QE was gradual, reflecting the Fed's cautious optimism about the sustainability of the recovery. Today, the long-term effects of quantitative easing continue to be debated. While it helped avert a deeper economic catastrophe, questions remain about its implications for future monetary policy and economic stability.